Like most other economies or societies around the world, the Australian government deemed it necessary to impose some pretty severe restrictions on the gathering and movement of people in an attempt to stop the spread of the virus. Australia's restrictions were by no means as strict as those which had been imposed in some other countries, including our near neighbour New Zealand. But I think evidence is starting to show that what matters more for success in controlling the virus is not the strictness of the restrictions themselves, but how quickly they're imposed after it's become clear that the virus has actually emerged in particular communities. So you can see, for example, even countries like Taiwan and Japan, which have had a fair measure of success in containing the virus without imposing strict restrictions, the advantage they had, or one of the advantages they had, apart from the culture of wearing masks, which has been long established in most Asian economies, was that their governments acted very quickly after the virus was first detected. Whereas a lot of other countries, including the United States and many European countries, were rather slow to act. With the benefit of hindsight, Australia could have moved more quickly than it did, in particular to close its borders to countries other than China and then Iran and Italy. We should have closed our borders to the United States when we did close our borders to China, because we actually had more transmissions of the virus from people returning from or arriving from the United States than we did from China. But nonetheless, in most other respects, the Australian government moved fairly quickly to impose restrictions. If you look at the number of days restrictions in Australia were at their highest level, it wasn't very long by international standards, or to take another way of thinking about the same thing, how long were our restrictions above 70 on the index of stringency of measures compiled by people at Oxford University School of Government. Again, we're sort of in the bottom half of those by comparison with others. And that does in some ways mean that the economic consequences of the restrictions, though obviously severe, haven't been as severe as they were in some of the countries that we've just been reviewing here. We did see economic activity contract by 0.3% in the March quarter. That was the first contraction in real GDP in Australia since the March quarter of 2011, when Brisbane was hit by devastating floods. Last week, the Australian Treasury forecast in the Treasurer's July economic and fiscal update that real GDP would contract by 7% in the June quarter, and then with the easing of restrictions rise by just over 1% in the September quarter. Much of the downturn in real GDP in the March quarter came from consumers cutting back on discretionary spending, either voluntarily or because the stores where they might undertake those sort of spending weren't allowed to open. Households didn't see a big drop in their incomes in the March quarter because declines in personal wages were more than offset by increased government payments to households. It's also interesting to note that households appear to have saved the tax cuts which many of them received in the third quarter, the September quarter of last year. And that's something that I think does have lessons for how the government might seek to provide fiscal stimulus as we look to the recovery from these shutdowns. And I'll say a bit more about that in a few moments. Business investment, both in the mining sector, where it had been very weak for a long time, and in the non-mining sector was soft in the March quarter. But what was stronger and partly offsetting that weakness was government spending. In fact, this chart highlights that government spending, whether it's consumption spending, particularly on the National Disability Insurance Scheme, or infrastructure spending, particularly by state and local governments, has actually accounted for slightly more than half the growth in real GDP over the last 5 years. And that's a pattern that's probably going to need to be continued over the next 2 or 3 years if we're to arrest the rise in unemployment and bring it down after the worst of the downturn has passed. What this means, of course, is that Australia's record-breaking run of more than 28 years of continuous economic growth without consecutive quarters of negative economic growth has now finally come to an end, and 2020 is, like it is for many other countries, going to see Australia's biggest contraction in real GDP since the Great Depression of the 1930s. You can see the impact of restrictions across different parts of the economy, which shows that 3/4 of businesses in June were operating under modified conditions, as they described them to the ABS. The impact has obviously been biggest on various parts of the services sectors, but construction, for example, has also been impacted. And so initially was the mining sector, although that appears to have recovered more since the middle of May. Small businesses were impacted in many ways, but it's interesting to note that the proportion of businesses that are trading as normal is higher among small businesses than it is among big businesses. Government policy is obviously focused on providing assistance to smaller businesses and making the assumption that big businesses have sufficient financial resources to look after themselves without needing assistance from government. I'm not sure that's right in all cases, but it's obviously one way of minimising the call on government spending for assistance. Looking again at a different dimension of this, 2/3 of businesses reported lower revenue in June of this year. That was after restrictions had begun to be eased than in June last year. And of those who did report lower revenue compared with a year earlier, 30% of them reported declines of more than 50%. Again, you can see that sectors such as accommodation and food services, art and recreation, or more broadly tourism, have been amongst the most severely affected, and we'll see that's also been the case when it comes to employment. Over the first 2 months of the shutdown, about 870,000 Australians lost their jobs. Almost 1/4 of those who lost their jobs in March and April recovered them in May and June, and another 70,000 or so started looking for work. As in the United States and other countries, a significant number of those who did lose their jobs dropped out of the workforce altogether. They weren't required to actively look for work in order to qualify for unemployment benefits, or job seeker as it's called in this country now, as they normally have been required to do. So that probably exaggerated the decline in the participation rate. Officially, the unemployment rate has risen to 7.4% as of June, from 5.2% in February and March. That unemployment rate would have got up to 11.7% in May if the people who dropped out of the workforce had actually been counted as unemployed. That number in turn would have fallen to 10.2% in June, which isn't as bad as in the United States or some other countries, but still the highest it's been in Australia since the recession of the early 90s. Of course, not only did many people lose their jobs, many of those who kept them were working fewer hours than they normally would. Underemployment peaked at 14.7% in April and is still close to a record high at 12.6% in June. Or if we add together those who are unemployed and those who are underemployed, working fewer hours than they'd like to, that measure of labour force underutilisation is only just below its May peak of 20%. It was 19.1% in June. Another way of capturing the decline in the demand for labour, one that the Reserve Bank says is a better measure, is the decline in hours worked. The Reserve Bank had thought that that could fall by 20% during the June quarter. As things have turned out, it only declined by a bit over 10.5% in April and May. It recovered about 4% in June, so it's now just under 7% below its pre-pandemic peak. That's still a very big decline, but not as bad as it could have been. Most of the job losses between February and May, that's the middle month of each quarter when we get more detailed data on employment and unemployment, 58% of the job losses were in 3 sectors: accommodation and food services, education and training, and arts and recreation. At least the first and third of those were the 2 that were most severely impacted by the restrictions on the movement and gathering of people. If we look at it by occupations, 3 occupational groups, community and personal service workers, sales workers and labourers have accounted for 3/4 of the job losses since February. That's a much bigger proportion of job losses than their shares of pre-pandemic employment, as you can see from the right. And another way of looking at it is by gender. Women accounted for 53% of the job losses that occurred between February and May. That's largely because women tend to work in the industries or in the occupations which have been hardest hit by the shutdown, although there are some sectors and some occupations where women lost a bigger proportion of their jobs than men in the same occupation or industry. You can see that, for example, among managers and professionals, or you can see it by industry in retail or rental hiring and real estate, where many more women lost jobs than men in the same industry. Not sure why that's so. And the final dimension I wanted to highlight was that, at least initially, young adults bore a much greater share of the job losses than older folks. In March, people aged between 15 and 25 accounted for about 1/6 of the workforce, but they experienced almost 2/5 of the jobs lost since March. I'll show you in a moment that that's actually changed quite a bit since the end of May, but at least initially it was teenagers and people in their 20s who experienced the greatest share of job losses. I mentioned before that the official unemployment rate, as published by the Stats Bureau, doesn't fully capture the extent of job losses or increase in joblessness, in part because it doesn't count people who've dropped out of the labour force altogether because they're not actively looking for work. There's another group of people who are also not counted as unemployed, even though they're not working, because they have been supported by the government's JobKeeper program. That's the program that at the moment is paying eligible employers 1,500 Australian dollars a fortnight for each employee who's kept on the payroll, and you can see the eligibility criteria for that. Many of those people are being paid by their employer, that's the way the scheme works, and so are counted by the Stats Bureau as employed, even if they actually haven't worked any hours during the week in which the survey was taken. In the US and Canada, people in that position, furloughed as they say, are counted as unemployed, but here in Australia they're counted as employed. If those people had been counted as unemployed, as they would have been in the US or Canada, in addition to the people who dropped out of the workforce, then the unemployment rate in Australia would have, at its worst, been 14.9% in April and 14% in May. With a large number of people returning to work in June, that figure would have been about 11.5%, and that of course is considerably higher than the official unemployment rate. Another way we could have gauged a better understanding of the extent of joblessness would have been by looking at the number of people being paid job seeker allowances, as they're now called, or youth allowance payments. That's what used to be called unemployment benefits. That data is published monthly by the Department of Social Security, but with a very significant lag. The government does collect weekly data on the number of people collecting those benefits, and on a couple of occasions earlier this year, that weekly data was presented to a Senate committee that's conducting an inquiry into the government's response to COVID-19. Unfortunately, however, the government seems to regard that information as a state secret. It's made available to ministers and government officials, but not shared with the general public. That's in contrast with the United States, which has been publishing this data every Thursday morning since 1968. And if it was published here, as I think it should be, then we'd get a much more timely handle on what's happening to the joblessness queues around the country than we get from the official data. But so far, at least, the government has resisted calls for that information to be made public, which I would say is something of a pity. I mentioned before that there is another series that the Stats Bureau has begun publishing this year with using information from the Australian Tax Office provided by employers when they withhold tax instalments from their employees' wages or salaries. That's part of a broad effort the ABS is commendably making to provide policymakers and the public more generally with more timely information about how the pandemic and government restrictions are impacting families, businesses, and the broader economy and community. The most recent set of this data that was actually released yesterday morning shows that the labour market has had a setback since the middle of July, with payroll employment falling in each of the last 3 weeks. Now, I should emphasise this data isn't seasonally adjusted, so some of these movements shown in the chart could be the result of normal seasonal factors rather than strictly the result of the pandemic or of government restrictions. But it is consistent with anecdotal evidence, particularly from Victoria, that the second shutdown is biting on jobs. I should also mention in passing that this isn't exactly the same as the employment numbers published in the monthly labour force survey. It counts jobs, not people. It double counts people with 2 or more jobs, who represent about 6% of the workforce, and it doesn't include employers or the self-employed. But nonetheless, it does give us a much more timely insight into what's happening at the labour market, and it seems reasonable to conclude that the recovery in employment that I mentioned before in May and June has, it would seem, come to a halt in July. As the headline says, that's partly because of the renewed shutdown in Victoria, but it's not solely Victoria's fault. We've seen employment fall by this measure in every state and territory except Western Australia since the middle of July, and in Western Australia it's been flat. This chart shows that on net, since the shutdown began in mid-March, the greatest job losses have been in Victoria, where they're down 7.3%, and in Tasmania, where they're down 7%, whereas in Western Australia, where the mining sector is a much bigger employer than it is anywhere else, the net decline in employment has been only just a little bit over 3%. It's no longer true, as it once was, that women and teenagers have borne the brunt of job losses. Initially, that was the case, but according to the payroll data, since about the end of April, women have been able to claw back much bigger proportion of the jobs they initially lost than men. And the same has been even more true of teenagers, so that actually now they're the least affected by job losses on net, and the most affected are the very small number of people who are in their 70s and the rather larger number of people who are in their 20s. And as you can see, men now on net have lost slightly more jobs than women have done. The same mobility data produced by Apple and Google that I referred to before when talking about major international economies also presents a similar picture of Australian lives. For a while there, from early April through to the last week of June, the amount of driving, walking, and to a much lesser extent catching public transport that Australians were doing had been recovering. But since the first week of July, you can see that all 3 of those have gone into reverse. The Google data likewise says that the number of people in workplaces began to fall in early July. There's been a bit of a recovery at that, it would seem, in recent weeks, but still not back to where it was at the end of June or in early July. And the number of, or the amount of time people spending at home, which had been gradually declining, has leveled out in recent weeks. Again, that partly reflects what's going on in Victoria, but it's not only the result of Victoria. That slowing has been apparent in New South Wales as well, although Queensland, the Northern Territory and Western Australia, people still seem to be gradually returning to more normal levels of activity. Let's just have a quick look at some of the other more traditional economic data. As in the United States, we saw a surge in retail sales in May, and it would seem a further small increase in June, so that in May at least, and probably in June, retail sales are probably back to where they were before the restrictions came into force. There was a surge of panic buying of things like toilet paper, rice and pasta, towards the end of March, ahead of the shutdown. And in May, we saw a surge in spending on things that people couldn't buy during the shutdown, such as clothing and footwear. It remains to be seen whether that'll be sustained through July and August during the second shutdown that Victoria's experiencing. Motor vehicle sales plummeted, of course, when people couldn't go out and inspect new cars and were cutting back on discretionary spending. In June, however, there was a surge of almost 40%, partly fueled by the government's instant asset write-off for small businesses. There were a lot of utes and commercial vehicles sold during June, and it would seem that motor vehicle dealers offered some pretty juicy end of financial year incentives to clear their sale yards as well. Again, be interesting to see whether that spills over into July and subsequent months. The pandemic and the lockdown has accelerated changes in the way Australians shop and make payments. Perhaps not surprisingly, there's been a very dramatic increase in the share of spending that's done online rather than in bricks and mortar retailers. That was a trend that was underway anyway, of course, as in other countries, but the lockdown has given it an almighty kick along. Likewise, while there had been a gradual decline in the use of cash over the last 15 years, that dramatically accelerated during the pandemic, partly because people were buying more things online, but also because a lot of businesses are reluctant to handle cash for fear that it might be another way of transmitting the virus from customers to their employees. People aren't taking as much money out of ATMs. They're not doing as many cash outs at supermarket checkouts. They're certainly being less enthusiastic about taking cash out on their credit cards, and instead a lot more payments are being made by direct entry, by direct debit or direct credit than had been the case before the pandemic broke out. As I say, many of those trends were underway before, but have significantly accelerated in recent months. The property market hasn't been all that much affected, at least in terms of prices, by the pandemic. Particularly in Sydney and Melbourne, prices did fall by about 1% over May and June. We'll get July data at the beginning of next week. Most of the declines were in the top end of the market rather than in the middle or at the bottom. What's notable, of course, is that sales volumes have fallen very sharply, largely because for some of that time, real estate agents couldn't conduct auctions. They weren't allowed to conduct open house. That's recovered to some extent, although July will have seen another setback in Melbourne. I suspect that we will see falls in property prices when the market reopens more fully later this year, and particularly when the mortgage repayment holidays that more than 10% of mortgage borrowers have taken up expire. There'll undoubtedly be some people in that category who feel they can't continue to service what will be higher levels of debt because the interest they haven't been paying has been added to their outstanding principals. And in the absence of demand from new migrants, with our international borders remaining closed for some time, that probably means both increased sales, increased sellers, and less demand. Well, you don't need an advanced degree in economics to know what happens to prices in those circumstances. I don't necessarily buy the argument some put that prices could fall by 30% or more, but I wouldn't be completely surprised if from pre-pandemic levels through to, say, the middle of next year, prices in Sydney and Melbourne fell by, say, 10% or a little bit more. We're also seeing some downward pressure on rents as vacancy rates rise because we don't have as many students or other migrants seeking short-term accommodation or longer rentals. Quite a lot of young people who've lost their jobs appear to have gone back to live with their parents if they can. And that means that landlords who aren't allowed to evict tenants under rules introduced by state governments are offering discounts in some cases to make sure their places stay tenanted. And you can understand why they might be about to do that. Turning to the housing market itself, or the level of housing activity, We've certainly seen a decline in lending to investors that really began 3 or 4 years ago, and what had been some recovery in lending to owner-occupiers also seems to have gone into reverse. Most of the lending that banks are doing for housing now is refinancings of existing mortgages at much lower fixed rates. Again, that's a rational response for people to do. I suspect we are going to see a significant downturn in the level of new construction activity once the pipeline of orders that were in hand when the restrictions first hit, or on big projects, especially apartments that were underway anyway, has started to run down. Volume builders reported a surge in new contracts signed during the last few weeks of June in response to the government's home builder incentives that were announced a few weeks back. They are limited to the end of December, so they won't help all that much beyond then unless the program is extended. Now, I've got my doubts about how effective schemes like this are, as people who followed my work may realise, but I think dwelling construction is going to be an area of medium-term weakness for the economy. Business investment more broadly is also likely to be weak for some time, reflecting the uncertainties about the outlook and perhaps difficulties that businesses have in attracting finance. Not that they've had much difficulty so far, but what is striking is that in the ABS Capital Expenditure Survey that was conducted in early April, businesses had been revising down their initial expectations for investment spending in the 2021 financial year. Normally at this time of year and for succeeding quarters, they're revising up their investment intentions as their plans become firmer, but that's clearly not happening at the moment, and I suspect we'll see further downward revisions when that time comes on. Commodity prices have held up reasonably well since the onset of the pandemic, particularly in the resources sector. In the case of iron ore, that reflects the fact that Chinese demand has remained reasonably strong, but Chinese production is substantially lower than it was for most of the decade. So Australia has had a bigger share of normal than the market, and that's put significant demand and significant upward pressure on prices. Eventually, Brazil production will come back when they fix their tailing dam problems, but that probably won't be before the end of the year, so iron ore prices are likely to remain high. China is seeking to develop other sources of supply, especially in West Africa, in Guinea and Mauritania and countries like that, but that's going to be a slow process, and I think whatever the deterioration in relations between Australia and China might take us, it probably won't affect iron ore sales. Partly because of the strength in iron ore exports, but also still strong volumes of coal and LNG. Exports have held up pretty well. Imports have fallen quite a lot, reflecting weaker demand. And of course, Australians haven't been able to travel overseas. So our trade balance has remained pretty strong. We're running bigger surpluses on services than we have done for a long time. And overall, Australia is continuing to run a current account surplus. The dollar has recovered more than the ground it lost during the market turmoil of February and March. That's partly because of a weaker US dollar itself, but it also reflects strong iron ore prices and a recovery in investor risk appetite that always has some impact on sentiment towards the Australian dollar. Finally, in this review of how the Australian dollar has been tracking, I should mention the inflation figures that came out this morning, Australian time. Australia recorded a fall in the consumer price index in June of 1.9%. That's the largest quarterly decline since 1931. It's only the 11th decline in the last 60 years. The annual inflation rate fell to 0.3%, which, apart from the decline that was associated with falling mortgage rates in the late 90s, they're probably no longer included in the CPI. That was the first annual fall since, or at least the largest decline in annual inflation since 1944. This wasn't, however, a sign that Australia is falling into sustained deflation. Rather, it was largely the result of the government's decision to make childcare free for a large part of the June quarter. That subtracted more than a percentage point from the CPI in the June quarter, and a fall of nearly 20% in petrol prices that subtracted almost 3/4 of a percentage point from inflation. Those two things are going to reverse, of course, in the current quarter, so I wouldn't be surprised if the CPI rises by at least 1% in the September quarter when that data is released in 3 months' time. Underlying inflation, which is what the Reserve Bank focuses on, was flat in the June quarter, and at an annual rate from this time last year was 1.3%. That's, of course, still below the Reserve Bank's 2 to 3% inflation target, as underlying inflation has been now for more than 4 years. Rents and house prices will continue to exert downward pressure on inflation for a while, as I suspect will wages, which haven't been a source of inflationary pressure for the past 6 years. Last week's economic update from the federal government forecast wages growth of just 1.25% over the year to the second quarter of next year, which is a very low figure by historical standards. I hope you found it useful. I just want to mention first that if you're interested in how COVID-19 is affecting Asian economies, you can join me at the same time on Friday afternoon when, in a somewhat shorter presentation, I'll be going through the impact of that. You can go to my website, whose address is shown here, for details of that. The charts I've used today will also be available on the website after the Friday webinar. They'll probably go up on Saturday. To get those and to subscribe and to get a weekly update of those charts, you'll need to subscribe, and you can find out how to do that on the website. There's a little bit of time left for questions if there are any, but otherwise, can I thank all of you for being here for this webinar? I hope you found it informative. I'd encourage you to look at the website and hopefully sign up for access to other presentations and material, and to get a weekly update of these and other charts that might help you understand the broader economic environment and maybe of assistance to you in making your business, investment, or other personal decisions. Again, thanks for joining us. It's been a pleasure having you with us. Thank you, and good evening or good afternoon.